There is no way to predict whether the price of stocks and bonds will go up or down over the next few days or weeks. But it is quite possible to foresee the broad course of the prices of these assets over longer time periods, such as the next 3 to 5 years. This finding, which may seem both surprising and contradictory, were made and analyzed by 2013 Nobel Prize winners Eugene Fama, Lars Hansen, and Robert Shiller.
On October 14, 2013, the Royal Swedish Academy of Sciences has decided to award the Severidges Riksbank Prize in Economic Sciences in memory of Alfred Nobel for 2013 to Eugene Fama, University of Chicago, Illinois, USA, Lars Hansen, also University of Chicago, Illinois, and Robert James Shiller, Yale University, New Haven, California, USA, for their empirical analysis of asset prices. Fama, Hansen, and Shiller have developed new methods for studying asset prices and used them in their investigations of detailed data on the prices of stocks, bonds, and other assets. They have revealed a number of important regularities that are helping us to understand better on how asset prices are determined. The behavior of asset prices is essential for many important decisions. The choice on how to save, in the form of cash, bank deposits, or stocks, depends on what one thinks of the risks and returns associated with these different forms of saving. Asset prices also fundamental importance for macroeconomy regarding decisions, consumption, and investment in physical capital, such as building and machinery. Mispricing of assets may cause financial crises and global recessions. Fama's research at the end of the 1960s and the beginning of the 1970s showed how incredibly difficult it is to beat the market, and how incredibly difficult it is to predict how share prices will develop in a day's or a week's time. The conclusion forms the basis for the theory that financial markets are efficient and led to the development of stock index funds. Fama concludes that in efficient markets, prices incorporate all available informations. He also showed in later work that so-called value and small-cap stocks have higher returns than growth stocks, and he rejected the notion that markets often produce bubbles. The efficient market hypothesis, EMH, is an investment theory that states it is impossible to beat the market because stock market efficiency causes existing share price to always incorporate and reflect all relevant information. According to the EMH, stocks always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing, and that the only way an investor can possibly obtain higher returns is by purchasing riskier investment. Financial markets called efficient if the price formed in the markets already represent all relevant informations at that time. These informations will lead investors to react by selling or buying stocks. The combination of positive and negative informations will drive up the consensus that formulated in prices. After the market becomes efficient, then the movement of the price becomes unpredictable, which Fama mentioned as random walk. The information that derives prices can be classified into three categories: all historical information, which specify as a weak form, all public information, semi-strong form, and all public and private information, strong form. This figure shows excessive swings in stock prices, means A high ratio of price relative to dividends in one year will tend to be followed by a fall in prices relative to dividend over subsequent years and vice versa. Robert Shiller discovered in the early 1980s that stock prices fluctuate much more than corporate dividends, and that the ratio of prices to dividends tends to fall when it is high and to increase when it is low. This pattern holds not only for stocks but also for bonds and other assets. Shiller has argued that the predictability of prices reflects irrational but repeating patterns in human behavior, and he is among of a group of prominent economists who are trying to integrate behavioral theories from physiology and other social sciences into a rigorous model of economic activity. In his 1984 paper, Shiller provided the most influential arguments which led to growing research literature in behavioral finance. The lack of risk-adjusted price predictability does not preclude the existence of irrational investors. The trading of such investors could make prices excessively volatile and noisy, which should make deviations from a random walk very hard to detect over short horizons. In other terms, the power of short-run predictability tests is likely to be very low. The stock prices are particularly vulnerable to psychological biases because of the ambiguity in the true value of a stock due to the lack of an accepted valuation model. These psychological biases are reinforced and exacerbated by social movements because investors are subject to group psychology dynamics, such as peer pressure. Hence, one investor's opinion of the value of a stock is likely to be affected by the opinions of others. As a result, as opinions diffuse throughout the population, stock prices will fluctuate in a way similar to what would be caused by fads or fashions. How should longer-run predictability of asset returns be interpreted? One approach interprets these findings in terms of response by rational investors to uncertainty in prices. High future returns are then viewed as compensation for holding risky assets during unusually risky times. Lars Peter Hansen developed a statistical method called the generalized method of moment that is particularly well suited to testing rational theories of asset pricing. Using this method, Hansen and other researchers have found that modifications of these theories go a long way toward explaining asset prices. Hansen provided the necessary statistical tools for dealing with estimating dynamic economic models using panel data, where serially correlated variables are commonplace and where specifying a full model is not always desirable or even possible. GMM can be applied to a subset of the model equations. GMM has made a huge impact in many fields of economics where dynamic panel data are used, for example, to study consumption, labor supply, or firm pricing. It is now one of the most commonly used tools in econometrics, both for structural estimation and forecasting, and in microeconomics, as well as macroeconomic applications.
These 2013 Nobel winners represent a very interesting connection because Fama is the founder of the efficient market theory while Shiller is one of the critics of it. The choice of having Hansen complement to the two extremes of efficient markets and inefficient markets is the perfect balance between the two. Nonetheless, these winners, they are usually called laureates, have laid the foundation for the current understanding of asset prices. It relies in part on fluctuation in risk and risk attitudes, and in part on behavioral biases and market frictions. The answers from this research are continuing to help us solve important problems that affect all of our lives in important ways. It is clear, especially at the present time, that better understanding of the vagaries of financial markets can help us make the best possible financial decisions and teach us how best to formulate appropriate financial regulation. These are essential factors for the proper functioning of the economy as a whole. I am John. Thank you.
I would like to invite all of the laureates on stage and take the opportunity to give them another big hand.